The bull case, the strategic evolution of a global infrastructure leader. The investment thesis for Vopak is fundamentally rooted in its transformation from a traditional tank storage company into a specialized provider of critical infrastructure for the global energy and manufacturing sectors. With a lineage spanning over 4 centuries, Vopak has historically demonstrated an unparalleled ability to adapt to shifts in global trade and commodity flows. The current strategic orientation, codified as the Improve, Grow, and Accelerate framework, represents the most significant pivot in the company's modern history. This multi-year strategy is designed to decouple the company's financial performance from the volatility of crude oil markets, while positioning it at the center of the transition toward lower-carbon energy carriers and industrial feedstocks. Under the Improve pillar, Vopak has focused on maximizing the efficiency and safety of its existing global network. This has involved the divestment of underperforming or non-core assets, such as the chemical terminals in Rotterdam, Botlek, TTR, and Chemiehaven, and its terminal in Savannah, USA. These divestments were not merely reactive, but were part of a proactive effort to sharpen the portfolio toward assets with higher cash return potential and better alignment with long-term energy security needs. The success of this pillar is evidenced by the structural expansion of the proportional EBITDA margin, which reached 58% in the 2025 fiscal year, up from 56% in 2021. By shedding lower-margin chemical distribution assets, the company has effectively increased the stickiness of its revenue streams, as the remaining assets are more deeply integrated into the industrial clusters they serve. The Grow and Accelerate pillars focus on expanding Vopak's footprint in gas infrastructure and new energy solutions. This involves a shift in capital allocation toward liquefied natural gas, LNG, liquefied petroleum gas, LPG, and industrial terminals, which now generate approximately 40% of the company's total EBITDA. Vopak's ambition to invest €4 billion by 2030 is supported by a robust pipeline of projects, with €1.9 billion already committed since 2022. This shift is particularly evident in the Accelerate category, where Vopak is developing infrastructure for hydrogen, ammonia, CO2, and battery energy storage, areas expected to become the backbone of the future energy economy. Vopak's competitive advantage is further bolstered by its irreplaceable global network. Operating 75 terminals in 21 countries, the company manages approximately 36 million cubic meters of storage capacity at the world's most critical ports. These locations, such as Rotterdam, Singapore, and Houston, serve as toll gate infrastructure that facilitates the global balancing of supply and demand. The take-or-pay nature of Vopak's contracts, which account for roughly 80% of revenue, ensures a high degree of cash flow predictability, even during periods of commodity price volatility or trade flow disruptions. This stability is a cornerstone of the bull case, as it provides the financial foundation for both high shareholder distributions and ambitious reinvestment.
The fiscal year 2025 served as a definitive proof of concept for Vopak's financial strategy, delivering record financial results characterized by strong cash generation and improved capital efficiency. The company achieved a record proportional EBITDA of €1,184 million, representing a 4.1% autonomous growth rate when excluding foreign exchange effects and divestments. This performance was particularly impressive given the significant currency translation headwinds faced throughout the year. The underlying strength of the portfolio allowed Vopak to not only meet but exceed its financial targets, leading to an operating cash return (OCR) of 15.6%, which outperformed the 15.1% recorded in 2024 and significantly improved upon the 10.2% seen in 2021. The primary driver of this record performance has been the structural improvement in EBITDA to cash conversion. By focusing on higher margin assets and reducing operating capital expenditure on existing facilities, Vopak has improved its cash conversion rate to approximately 70%. This improvement has had a direct impact on shareholder value, with proportional operating free cash flow per share increasing by 7% year-on-year to €7.13. The company's ability to generate such significant free cash flow from a stable revenue base is a key differentiator in the midstream sector. This cash generation engine is fueled by disciplined operating expenditure. Since 2021, the company has reduced its operating capex by 28%, while maintaining a high standard of asset reliability and safety.
A critical component of the bull case is the company's approach to capital employed and leverage. Vopak has successfully lowered its capital employed through the divestment of lower return assets, while redirecting capital toward growth projects that offer superior returns. Proportional leverage decreased to 2.6x at the end of 2025, which sits comfortably within the management's target range of 2.5 to 3.0x. Notably, excluding assets currently under construction, which consume capital but do not yet generate EBITDA, the leverage ratio stands at an even more conservative 2.06x, the lowest in 5 years. This balance sheet strength provides Vopak with the dry powder necessary to fund its Euro 4 billion investment ambition without compromising its investment-grade profile or its commitment to returning capital to shareholders. The resilience of the business is further reflected in its occupancy rates. Despite a slight decrease in proportional occupancy to 91.4% in 2025 compared to 92.5% in 2024, the rate remains exceptionally healthy and indicative of strong market demand for infrastructure services. The slight decline was primarily attributed to planned out-of-service capacity and temporary challenges at specific terminals, rather than a systemic decline in demand. The fourth quarter of 2025 showed a strong recovery, with occupancy rising to 92.4%, suggesting that the negative drivers were transitory. This high occupancy, combined with inflation-protected contracts and the ability to pass on energy costs, ensures that Vopak's top-line revenue remains robust even in an inflationary environment.
Growth catalysts in gas infrastructure and emerging energy markets. Vopak's growth strategy is heavily weighted toward gas infrastructure, a segment that currently provides high-quality, stable earnings. The global demand for energy security and the role of LNG and LPG as transition fuels have created significant opportunities for Vopak to leverage its existing port footprint. The company's growth strategy is characterized by the expansion of its base in industrial and gas terminals, which are typically underpinned by long-term customer commitments. In 2025, gas and industrial infrastructure contributed approximately 40% of the company's EBITDA, a figure expected to rise as a pipeline of major projects comes online through 2026 and 2027. One of the most significant growth catalysts is the progress made at the Gate terminal in the Netherlands. Vopak recently took a final investment decision, FID, for a fourth tank and a new jetty, aimed at strengthening its market leadership in LNG bunkering in Rotterdam. This expansion is critical for Northwest Europe's energy security and provides Vopak with exposure to the growing LNG fuel market for the maritime sector. Similarly, in Western Canada, Vopak and its partner AltaGas are developing the Reef LPG terminal, a large-scale export facility that will connect North American natural gas liquids to high-demand markets in Asia. These projects exemplify Vopak's ability to identify and execute on large-scale infrastructure needs that offer attractive long-term returns.
The Indian market represents another core growth engine for Vopak through its joint venture, Aegis Vopak Terminals Limited, AVTL. The successful IPO of AVTL in 2025 not only provided a valuation benchmark for the company's Indian assets, but also generated a €111 million exceptional gain. AVTL is aggressively expanding its footprint, with plans to build a greenfield ammonia terminal and acquire a 75% stake in Hindustan Aegis LPG Limited. This position allows Vopak to capture the rising demand for fertilizers and clean energy in one of the world's fastest-growing economies. The joint venture structure in India and other regions allows Vopak to share capital costs and risks with local partners while maintaining its high operational standards. In addition to traditional gas infrastructure, Vopak is accelerating into the energy transition by developing new supply chains for hydrogen, ammonia, and CO2. While these markets are currently in the early stages of development, Vopak is positioning itself as a first mover in infrastructure solutions. This includes exploring green hydrogen imports from Portugal to the Netherlands and investigating liquid CO2 hub terminals in the port of Rotterdam and Southeast Asia. The company has already repurposed 22 oil storage tanks in Los Angeles for sustainable aviation fuel, SAF, and renewable diesel, demonstrating a cost-effective way to transition legacy assets into the new energy economy. This strategic foresight is a primary pillar of the bull case, as it ensures Vopak remains relevant in a decarbonizing world.
Shareholder returns and the strategic capital allocation pivot. The final piece of the bull case, and the bridge to the bear case, is Vopak's enhanced shareholder distribution program. The company's record cash generation has enabled a step change in how it returns value to its owners. Management recently announced a distribution program of approximately €1.7 billion through the end of 2030, which includes a minimum 5% annual growth target for dividends and a multi-year share buyback program of up to €500 million. This commitment reflects a mature business that has successfully optimized its portfolio and is now prioritizing the return of excess capital. For the 2025 fiscal year, the proposed dividend increase of 12.5% to €1.80 per share signaled high confidence in the sustainability of future cash flows. The multi-year share buyback program is a key tactical tool in management's arsenal. By repurchasing and canceling shares, the company is effectively increasing the ownership stake of remaining shareholders in a record-earning business. The first tranche of €100 million is expected to be executed by February 2027. This program is particularly accretive given Vopak's relatively low PE multiple and the disconnect between its fair value and current market price. Since 2021, Vopak has already returned €1.2 billion through dividends and buybacks, illustrating a consistent track record of prioritizing shareholder interests alongside growth.
However, this aggressive distribution policy marks the beginning of the bear case considerations. While the distributions are currently funded by strong free cash flows, the company is simultaneously pursuing an ambitious €4 billion investment goal. This dual focus creates a tension between short-term payouts and long-term reinvestment needs. If market conditions deteriorate, or if major growth projects encounter cost overruns, Vopak may find itself in a position where it must choose between its distribution targets and its leverage ambitions. Management has acknowledged that leverage may temporarily rise to between 3.0 and 3.5x to fund construction, a level that could attract scrutiny from credit rating agencies if prolonged. Furthermore, the bullish momentum of the 2025 results has led to a significant surge in the stock price, which traded near its 52-week high of €48.10 following the earnings announcement. While the company's financial metrics are at record levels, current valuations relative to some fair value estimates suggest that the market may have already priced in much of the near-term upside. For new investors, the entry price is higher, and the margin of safety is narrower than it was in previous years. This transition from a growth and value story to a premium infrastructure story requires a closer examination of the external risks that could disrupt Vopak's finely tuned machine.
The bear case: geopolitical risks and trade route disruptions. The primary risk in the bear case for Vopak is the company's exposure to an increasingly volatile geopolitical landscape. As an operator of critical nodes in the global supply chain, Vopak's terminals are physically located in regions that are frequently at the center of international conflict. The recent drone attacks on the port of Fujairah in the UAE, which briefly halted operations at Vopak and other terminals, serve as a stark reminder of the vulnerability of energy infrastructure to regional instability. While the physical damage was limited, the psychological and insurance impacts of such events can lead to higher operating costs and potential disruptions in cargo flows. Geopolitical tensions also have an indirect impact on trade routes and commodity flows. The rerouting of trade due to conflicts or sanctions can significantly benefit some hub terminals while harming others. For instance, the rebalancing of trade flows following the Russia-Ukraine war initially supported storage demand in major hubs, but the long-term sustainability of these shifts is uncertain. Moreover, disruptions in major maritime corridors, such as the Suez Canal or the Panama Canal, can lead to volatility in throughput levels and potentially impact the demand for storage and bunkering services in peripheral ports. While Vopak's take-or-pay contracts provide a revenue floor, they do not insulate the company from the long-term risk of structural shifts in global energy trade. The chemical segment has been particularly vulnerable to geopolitical and economic headwinds. In 2025, Vopak reported lower EBITDA contributions from its chemical terminals, driven by weak market conditions, further amplified by imposed trade tariffs. This segment, which relies on the global flow of manufacturing feedstocks, is a leading indicator of global industrial activity. A prolonged period of protectionism or a systemic slowdown in manufacturing, particularly in China, could lead to lower occupancy rates in Vopak's chemical terminals, potentially forcing further divestments or impairments. The fact that chemical markets are currently characterized by oversupply and suppressed consumption in key regions adds a layer of risk to Vopak's diversified revenue model. Additionally, the regulatory environment in Europe presents a unique challenge for Vopak's Accelerate strategy. While the company is bullish on hydrogen and ammonia, the regulatory framework and subsidies for these new energy carriers are still evolving and vary significantly by jurisdiction. Management has noted that there is a bit of uncertainty on the regulatory part in Europe, which has slowed the pace of some new energy projects. This uncertainty can lead to wait-and-see attitudes among Vopak's potential customers, delaying the final investment decisions that are necessary to underpin the company's long-term infrastructure investments.
Transition risk and the slower-than-expected new energy adoption. A critical component of the bear case is the risk that the transition to new energy carriers, hydrogen, ammonia, and CO2, may take longer than the industry initially projected. While Vopak has committed significant capital to these accelerate projects, the development of full-scale supply chains depends on the participation of a wide range of partners, from producers to end users. In its recent communications, management admitted that progress in certain sectors, such as CO2 infrastructure and ammonia as a hydrogen carrier, has been slower than expected. These delays are often caused by the complexity of supply chain decisions, permitting hurdles, and the high cost of new technologies. The pause of the Houston Ship Channel low-carbon ammonia plant project is an illustrative example of this risk. Despite a fantastic footprint and world-class partners like Air Liquide and INPEX, the project was halted after one of the backers withdrew from essential auctions, removing the financial basis for the development. This highlights the execution risk in new energy projects, where Vopak is dependent on the long-term strategic and financial commitment of its partners. If similar projects face delays or cancellations, Vopak may find its accelerate capital underutilized or its growth targets difficult to achieve, leading to a reevaluation of its €4 billion investment goal.
Another risk is the potential for stranded assets in the traditional oil storage business. While Vopak is actively repurposing tanks for biofuels and ASF, not all legacy infrastructure can be easily or cheaply converted. The 2022 impairment charge of €468 million was largely driven by a revised asset valuation for oil assets in OECD countries, reflecting the expected impact of the energy transition on long-term revenue prospects. While some of these impairments were partially reversed in 2025 as short-term market conditions improved, the underlying long-term trend remains a decline in crude oil demand in developed markets. If the transition accelerates faster than Vopak can repurpose its assets, the company could face further impairments or significant decommissioning costs. Finally, the entry into battery energy storage, or BESS, represents a departure from Vopak's core competency in liquid and gas handling. While the company is developing assets with 4 to 8 hour discharge durations, the battery storage market is highly competitive and rapidly evolving. Unlike the tank storage business, where Vopak has 400 years of experience, BESS is a technology-driven field where Vopak must compete against specialized technology firms and utilities. If Vopak fails to establish a unique competitive advantage in power-to-power storage, its investments in this sector may yield lower than expected returns, diluting the overall profitability of the Accelerate portfolio.
Financial headwinds, currency volatility, and interest rate exposure. The financial bear case centers on Vopak's vulnerability to external macroeconomic factors beyond its control, specifically currency fluctuations and interest rate shifts. As a global company reporting in euros, Vopak faces significant translation risk. Approximately 72% of its proportional EBITDA is generated in non-euro currencies, including the US dollar, Singapore dollar, and Chinese renminbi. In the 2025 fiscal year, currency headwinds had a material impact, reducing proportional revenues by €51 million and proportional EBITDA by €33 million. Management has already warned that 2026 results are expected to be negatively impacted by roughly €20 million due to continued foreign exchange headwinds. While Vopak has historically managed its interest rate exposure effectively, the current high-rate environment presents a persistent headwind. Approximately 80% of Vopak's debt is at fixed rates, averaging 4.3%, while the remaining 20% is at floating rates, averaging 2.5%. While this provides some protection, the company's ongoing growth investments will likely require new debt issuance at prevailing market rates, which could be higher than its current average. An increase in the net finance costs would directly impact the net profit attributable to shareholders, particularly if the newly commissioned projects take several years to reach their full EBITDA potential.
The Better efficiency program has successfully reduced costs, but there are limits to how much operating expenditure can be cut without impacting asset integrity or safety. In 2025, operating expenses, personnel, and other increased to €673 million, up from €662 million in 2024, when adjusted for currency effects.
This was driven by higher development costs for new projects and increased maintenance expenses. If inflationary pressures on labor and materials continue to persist, Vopak may find it increasingly difficult to expand its EBITDA margins through efficiency alone, making organic growth in throughput and occupancy the only viable paths to higher profitability. Furthermore, the rebasing of the 2026 outlook indicates a potential slowdown in earnings growth momentum. Management's guidance for 2026 proportional EBITDA is in the range of euro 1,150 to 1,200 million. At the midpoint, this represents a flat to modest decline from the 2025 record of euro 1,184 million. This guidance reflects the loss of one-off items, such as a euro 22 million commercial resolution, and the impact of recent divestments. For a stock that has surged on record-breaking growth, a period of stagnant or rebased earnings could lead to a cooling of investor enthusiasm and a contraction in the PE multiple as the market adjusts to a new normal of steadier, lower growth.
Conclusion: the investment case for Vopak is a complex interplay between record-breaking current performance and the long-term uncertainties of a global energy system in flux. From a bull perspective, the company has never been stronger. The 2025 results demonstrate a highly efficient organization with a 70% cash conversion rate and an operating cash return that exceeds its own long-term targets. The shift toward gas and industrial infrastructure has structurally improved the quality of earnings, providing a resilient base of take-or-pay revenue that is largely insulated from the cyclicality of commodity prices. For income investors, the 1.7 billion euro distribution program and the 5% minimum dividend growth target provide a highly attractive total return profile. However, the bear case highlights that Vopak is operating in a more hostile environment than it was 5 years ago. Geopolitical volatility, trade tariffs, and currency headwinds are persistent drains on performance that are largely outside of management's control. The transition to new energy carriers is proving to be a marathon rather than a sprint, with delays in supply chain development and regulatory uncertainty slowing the pace of the Accelerate strategy. While Vopak's balance sheet is strong, the simultaneous pursuit of high shareholder returns and a 4 billion euro investment program requires a delicate balancing act that could be disrupted by a sudden economic downturn or a major operational incident.